Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks higher here as the rally resumes on Wall Street, this time driven by the Dow. Let's welcome in now Inez Ferre over at The Touch, joining us to break down the headlines. Inez, what are you seeing in the markets?
Josh, we are looking at session highs here with the Dow up 1.3%, the NASDAQ also higher, flipping into green territory because it was in the red earlier in the session, and the S&P 500 also up 0.7%. I should add that outperforming are the small caps. The hopes of a Fed rate cut in December would help out the small cap companies with debt on their balance sheets. Looking also at the 10-year Treasury note, that is at 4%. It had gone just below 4% earlier in the session, and the U.S. dollar is slipping a bit here. Also looking at the sector action, you've got healthcare, consumer discretionary. Those are in the green. Over on the Dow, the best performer, one of the best, let's say today. And if we take a look at the Dow, a mixed picture, and part of this has to do, of course, with the fact that you've got the retailers that have done well today. Some of the retailers that have reported their quarterly results, that's lifted the whole space up. So we're watching Walmart that's up more than 2%, Home Depot that's up as well. Amazon is also up. Over on the NASDAQ 100, again, a mixed picture here when you look at the mega caps, and Nvidia down 3% off the lows of the session, but you've got Alphabet that's up more than 1%. Another all-time high for Alphabet on that potential deal with Meta for Meta to be buying some of Alphabet's chips and Google chips and causing some competition for Nvidia. That's why you're seeing the disparity here among the Mag 7. But just looking at the market cap, we have been watching the market cap to see if it closes in. Alphabet inching up towards that $4 trillion mark. And then looking at crypto, we are seeing a bit of a picture here, a down day for Bitcoin, down 1.5%, around 86,000 per token, off the lows, of course, from Friday, but unable to really sustain that rally that we saw yesterday when it was up to about 89,000 per token, Josh.
All right. Thank you, Inez. While big tech is edging higher in today's session, the recent volatility has my next guest saying investors should pull back from the sector a bit. Join me now, we got Mark Travis, Intrepid Capital co-founder and CEO. Mark, it's good to see you here. So let's start there, Mark, because you do seem to suggest here that maybe investors are perhaps overexposed to tech. I guess right there, Mark, how would you kind of characterize that? How over-concentrated are they? And if they are, what, in your opinion, Mark, are the ways they would think about smartly rebalancing?
Well, I don't think it's an original idea necessarily of mine, Josh, and a lot of viewers know that the tech big seven are probably 40% of the S&P index. That's assuming they're indexed. But my guess is if you were to look inside a Fidelity or Schwab portfolio across their retail customer base, that there's a lot of NVIDIA, which has certainly done very well. Some of the other tech stocks haven't really done that well this year. And my only suggestion is if you have any losses, you maybe harvest them to bring down your position size. From a risk management perspective, as a portfolio manager, I think you get a position larger than 6 or 8% of your portfolio, and it really adds significantly to the risk of that portfolio. So I'm just trying to help people manage their risk.
All right, so to be clear there, Mark, you're not saying, listen, get out of AI-heavy names. You're just saying trim a bit.
Absolutely. Yeah. Trying to keep some balance in the portfolio. You know, things do go bump in the night. You never know when we're going to close down the government or make peace with Ukraine. But I think that a lot of investors didn't live through the tech bubble and the subsequent crash that took the NASDAQ, 12 to 14 years to get back to old highs. You do have a NASDAQ 100 that's annualized at slightly under 30% for the last 3 years. So I suspect that, has attracted a lot of investor interest. So I'm just trying to get people to recognize the risks they're incurring.
In terms of what you like, Mark, I thought this was interesting. You say stick with founder-led companies. What about, Mark, founder-led businesses? What are the characteristics there that you think drive kind of solid long-term results? And what would be some examples?
Well, The quote that I've always liked about business, Josh, is from the great race car driver Mario Andretti. To finish first, you must first finish. And so I think a lot of people, unfortunately, treat their broker as a bookie, and they're trying to, get rich overnight, which is really quite difficult to do. What I like about founder-led businesses is they tend to be more conservative with their balance sheets. A lot of times you see companies that are void of debt and have ample cash balances. So going back to when things go bump in the night, that balance sheet helps the company finish, so to speak, and maybe opportunistically expand their franchise, buying shares when they're at a discount to intrinsic value, continue to pay a dividend. So I think there are a number of them out there. They're not as sexy as maybe NVIDIA is right now, but I think over time they've done quite well for their shareholders.
What are a couple specifically, Mark, you would highlight?
Well, one that's probably not on many people's radar is a company called SS&C, run by the founder named Bill Stone. Anybody that's been around the industry maybe as long as I have is probably familiar with the software called Advent. That's a company they've purchased years ago, and they're the backbone of asset management, all types of reconciliation and trading, and they've done a nice job of growing their business over time. The other point I'd make about some of these companies is they're digestible in size, and that I like to find things between, say, a 2 billion equity market cap and say 30. So for some reason, the third generation comes along and has no interest in running the business. They're a digestible bite for a strategic or financial buyer.
Let me ask you, Mark, I thought this was interesting in terms of your suggestion for some reading for folks. You say you recommend investors read Warren Buffett's Thanksgiving letter, especially a reminder that Buffett endured multiple 50% drawdowns. How come, Mark? How should sort of investors read that, I guess, and then apply the lessons learned there, the perspective there, to their own risk-reward profiles today?
Well, Josh, you and I have been probably to many cocktail parties where someone's telling us how well they did buying Amazon shares way back when. And I know the press tends to have those, if you'd bought $10,000 worth of Amazon in 1992, you'd have $10 million. Netflix, pick one that's done exceptionally well over the last 30 years. What they forget to mention is the severity of the drawdowns those equity holders had over that long duration. I've looked, and a lot of them are as significantly as 90%, which I think that's a roller coaster ride that most wouldn't endure, and they most likely would sell at the bottom or some way on the way down. I think Mr. Buffett's just trying to emphasize that the equity markets can be fickle and prices can drop considerably, 50% or better, as he indicates with Berkshire, and to prepare yourself mentally for it. I think that my perspective on 40 plus years is not many people are mentally set up to deal with an all equity portfolio through the trough.
Mark, great to have you on the show today. Thank you, sir.
Thank you, Josh.
Coming up, we zero in on Alphabet's recent rally as it races toward that $4 trillion market cap. That's next on Market Domination. Shares of chip giants NVIDIA and AMD sinking today. This is coming after a report from the information that Google is in talks to sell billions of dollars worth of its own AI chips to Meta as competition in that AI chip race heats up. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, this is basically, kind of the story that we hear every so often. NVIDIA has competition, NVIDIA sinks, that competition rises, and then after a while, people kind of, filter back into NVIDIA. And so this is basically on this information report that Meta could use some of Google's TPUs, their tensor processing units. It's an ASIC, an application-specific integrated circuit. You don't have to know any of that. Basically, you just have to know Google has its own chips that it uses to run its own AI. Meta might start using them in their own data centers. this is if the deal actually does come together. It would be huge for Google. They already do rent out their TPUs to developers to run their software on Google's cloud platform. It's worth noting that we've been talking about NVIDIA having competition from its own customers like Google for some time now. So it's not as though this is completely out of nowhere. It's not that nobody thought that Google or Meta, which has its own chip, or Microsoft, which has its own chip, or Amazon, which just inked a deal with Anthropic to provide as many as a million or more of its own chips to run its own Claude models. This is all something that's been known. I think it's just the idea that two of these companies are linking up, and then NVIDIA came out today basically saying, look, our chips are a generation ahead of Google's, which I think people see, and then they're like, well, why is NVIDIA even responding to this? It could send a message that maybe they don't want the market to think that they're weak or anything along those lines. But the matter of fact is that NVIDIA puts out a GPU that's a general purpose computing device. It's, graphics processing unit. GPU stands for that, but it also does general computing. And so it can be used for a multitude of different tasks that require parallel processing, whereas an ASIC is application specific. It's literally in the name. And while, Google calls their chip a TPU, it's a category of ASIC. And so, it's not as though you can take that and dump it in and start running other models. There's also the software capabilities that NVIDIA has with CUDA. Google also has its own software. But I think, net, it's not as though this is the death knell for NVIDIA being the leader in AI. It just means that the competition that we at Yahoo Finance have been saying was coming from their own customers is finally here.
All right, Dan. Thank you, sir. Appreciate it. Well, the recent surge in Alphabet shares has it closing in on a $4 trillion market cap now. And joining us now to break down how Alphabet got here is our very own Jared Blickery. Jared.
That's right, one day at a time. What we're looking at right here is today's stock return. So Alphabet setting up for another record close, up about 0.8%. Meanwhile, NVIDIA down about 3.5%. I'm going to compare them, and I'm going to throw Apple in the mix too in a minute. But first, let's get a snapshot of that race toward $4 trillion. Here is Alphabet, just about 10 billion short of that. Meanwhile, NVIDIA recently hit $5 trillion, and then it has backed off. So it's in a little bit of a slump right now. And there's Apple down there comfortably above $4 trillion itself. And I thought next it'd be interesting to compare the performance of NVIDIA versus Alphabet going back about 3 years. By the way, November 30th is, I believe, the 3-year anniversary of OpenAI rolling out one of its ChatGPT versions that kind of launched it, catapulted it into the public conscience. So we are at that 3-year level right now. So here's NVIDIA up almost 1,000%. Alphabet, 230%. That's nothing to sneeze at, but look, you can barely see a blip down here. That's how great the NVIDIA performance has been. If we dial this down to year to date, though, you can see a different story. In fact, it's really interesting because NVIDIA and Alphabet, their fortunes were kind of tied throughout most of the year until very recently. It was within November that NVIDIA had its little slump, and Alphabet has really taken off, especially with that latest Gemini release to reach new highs. So that's what NVIDIA and Alphabet have done this year. Alphabet actually more than doubling its performance. Here's NVIDIA versus Apple. And Apple's been kind of slow off the dime here, but it is edging higher. I think it's on track for another record close. And I'll show you NVIDIA versus Broadcom. And Broadcom also doubling the performance of NVIDIA. I'm going to close here with a chart that shows you how many days it took for each of these three giants to get to these various thresholds. You can see NVIDIA basically took less than a year to get 1 trillion, to get from 1 to 2, 2 to 3, 3 to 4, 45. Apple took a lot longer. In fact, to get to 1 trillion, the first trillion-dollar company, that happened back in 2018, and it's been a little bit more slow going for it. Alphabet took the longest to get from 1 to 2 trillion, 1,500 days. But to get from 3 to 4 trillion would take an estimated 83 days. If we interpolate, it's been about 70 billion so far, and we know they have about 10 billion to go. So on that note, we'll be watching this story, and we'll update you when we finally hit that $4 trillion mark.
All right, thank you, Jared. Well, Google's recent rally has allowed the stock to outperform other big tech stocks like Nvidia, Microsoft, and Oracle. Stock is trading at a record high and closing in on a $4 trillion market cap after the successful launch of its new Gemini 3 AI model. Join me now on where Google stands in the AI arms race. We've got Brent Till, Jefferies senior analyst. Brent, always great to see you. So Alphabet, it's in the green again here today. We are nearing that $4 trillion market cap, Brent. Let's start with the latest news. We have the information reporting. Okay, Meta's in talks with Google to spend billions on Google's chips in its data centers. You cover both Alphabet and Meta. You like both those names, Brent. You saw that headline. You saw that report. What did you make of it?
I mean, it's good news for Google, but it's not the end all be all. Remember, everyone is using everyone else's stuff because there's such huge demand. NVIDIA can't actually fulfill all the demand that's needed. So I think no one wants reliance on one vendor, right? So you're going to see diversification where you can do it. Secondarily, right now, everyone's capacity constrained. We talked to Microsoft, Google, Amazon. Effectively, all their backlog numbers are way higher than the reported revenue numbers because they're booking deals that they can't actually fulfill right now. And so you're seeing bookings higher than the revenue because of the demand so high. So I think spreading and diversifying the risk to NVIDIA also, no one actually has enough demand. I think at the beginning of this, or enough supply, at the beginning of this entire movement, everyone felt like we would go to one cloud. We would not make the mistake we did in the cloud in the past cycle, which is spread all our workloads everywhere. And the same thing's happening because you don't want over reliance and you want effectively, you can't get enough supply. So you're having to go to multiple vendors right now. So I think, look, the news flow was incredibly negative at the beginning of the year on Google. Everyone thought they were left for dead when you think about the transition to AI from search. And they've done a fantastic job of navigating this. Recently, you've now seen the anti-NVIDIA trade. So everything that's in the NVIDIA camp goes down and everything else in the Google camp goes up. And you've seen this. So right now we're in kind of the flavor of the week, if you will, which is Google's doing everything. There's nothing wrong. They can't make any mistakes. But that's kind of market we're in right now. I mean, honestly, I think Meta's a way better buy down here than chasing Google at current levels. But right now, investors, again, are just chasing the momentum.
Well, let me ask you, Brent, because we talked about Google chips, but I do because I have you here. I want your take on Gemini 3 as well. There was a lot of excitement there. I'm curious your take on that as a financial analyst. You know, I saw Salesforce, Mark Benioff, apparently now, Brent, he's a Gemini guy. He says not Chat GPT. What do you make of Gemini 3?
Look, I think there's going to be a world where we use multiple AI agents. So the topic that's happening in our work is it's not Gemini, it's not ChatGPT, it's not Perplexity. We're going to use multiple agents. We're not going to use just one. And I know that Benioff's excited. He's dropping S-bombs on X about how good it is. But I think ultimately the technologies across the platforms are just getting better and better as you use them every day. There are going to be multiple technologies you're going to use. And so we don't believe it's a vendor take all. We think there's going to be room for multiple agents. There's going to be room for multiple technology vendors. What we've been saying, though, is that effectively there's only a few companies that have the dollars, the capital, and the actual users to make this happen. And you can count on one hand how many vendors can do this, right? It's Google, Amazon, Microsoft, Oracle. There's only a few. And so what I would say is, you know, for investors, you want to buy where the worst sentiment is. You don't want to chase the best sentiment, right? At the beginning of the year, Google had the worst sentiment, and look at the returns year to date. The worst sentiment now for investors to be buying into would be Meta and Oracle. I mean, stocks literally go down every day. And the businesses aren't that bad. It's just the momentum chase to Google is now like, there's not that big a stair step in what's happened in the business. The business in terms of the fundamentals are operating almost the same level as they were operating at the beginning of the year. It's just the sentiment turned. So I don't think it matters about chips or Gemini or whatever. I think it's a collection of things that Google's doing well that everyone should stay focused. Again, nothing to take away. We are big fans. We would stay along Google. But again, I think what you've seen is an oversold sentiment on the other side of this AI trade where, 2 months ago, Meta and Oracle couldn't do anything wrong. And these stocks were up massively, and now they just fell out of the sky. And that, to me, is a signal that something's wrong. When our fundamental work is that there's only a handful of companies that make it, that's, to us, the signal where the buy signal is much stronger at Meta and Oracle. It's not as strong at Google.
On Oracle, Brent, since you bring it up, listen, that one, to your point, it has been whacked here. The team at CFRA, I see they did downgrade Oracle to hold, and they were talking about mounting debt concerns. They bring up what they say is heavy reliance on OpenAI. But I know you like this name, so I guess what is your reaction, your response to that?
They just told you what you know. We've known that for a long time. It's not like there's anything new in that statement. So when you look at, I think what Oracle is, if you look like the stock ran on the OpenAI deal, effectively the entire value of that transaction is now out of the market cap. It's like OpenAI didn't even exist. And the success of what is happening in Oracle is broader than just what happened at OpenAI. So I think investors, again, this is similar to when the excitement on where we're at in Google right now, it happened in Oracle recently, where everyone's like out of their mind, like, oh my gosh, Oracle's winning everything, everyone else is dead, the whole AI trade's over, they're winning share, look at the numbers, Microsoft's done. You're like, this is crazy talk. Like, it's totally crazy. Yes, they have debt. Everyone knows they have a debt is part of their business model. But what I think they've been saying is that they've got great cash flow. They're not getting these AI deals from the lowest rung vendors. They're getting from the highest quality vendors. And so I think this kind of fear of being able to pay the bill is well embedded in the stock. So if an OpenAI comes out and says, look, we are fully good and we are fully endorsed on this contract and we don't have a funding issue, and we get some other clarification that Oracle's winning other deals beyond just OpenAI, which we believe they are, and they've said they are, once they put those numbers up in early December when they report, I think hopefully the bleeding in the stock can stop. But right now, it's been like yelling into the wind on Oracle. No one cares because it's effectively, there's an engine out at Oracle, engine out at Meta, and everyone cares. That's all we want to do is talk about Google. Google's a phenomenal company. But I'm telling you, the same thing happened at the beginning of the year with institutional investors. They could care less about Google. Most investors were underweight the stock, and things flip. And so my point is, like, I think things are going to flip back on Oracle. We think they flip back on Meta. And for patient long-term investors, this is an amazing opportunity to buy these names. These have gotten oversold.
I'll end here, Brent, on sort of when you look at big tech, how big tech is trading right now, sort of the divergences we're seeing, some of the names we're talking about. I've heard some commentary, and it goes like this. It'll be like, what's going on here is investors are starting to draw more clear, harder lines in the AI trade, and they're starting to pick out, hey, where's the ROI on all this spend? Who has the ROI? Who's going to get there fastest?
I don't believe that at all.
You don't? Okay, why?
No,
why don't you believe that?
Because like the market a month ago was paying 90 times revenue from Palantir, and I got beat up left and right, and all of a sudden stocks $30 lower, $40 lower. And, like the market has been so strange, and just they chase the flavor of the week, and they don't look at what's inherently behind the scenes, which is like, okay, everyone wants to talk about Google. That's great right now. But really, as an investor, you should be looking at what could change in the next 6 to 9 months. Are you going to make more money in Google, given the massive run it's had, or are you going to make more money in these other names? Yes. Is the market going to look and place trades on, there's an OpenAI camp, which you can put all the vendors in that, and you can put the Google, Broadcom, number of other names in the other camp of the anti-OpenAI trade. The anti-OpenAI trade is working because all the money that ran those up are now moving into these other names and pushing that narrative. The reality is the ecosystem is pretty healthy. The ROIs, which we're seeing, we have firm belief in. We've said this repeatedly. that the backlog the revenue backlog well exceeds that of the actual investment dollars. And we're going to get these movements where you get these moves in these stocks that get over exaggerated. And so what we're trying to point out is there's an over exaggeration right now. And that's it. And it's not like Meta and Oracle are going to walk out. I mean, Meta's in an unbelievable position. And I got a couple of hidden gems that I think are really going to be helpful to them, which is I think they're going to be a big vendor in the commercial world. They obviously they've sold advertising to consumers and to other brands, but I think long term, why is Meta not in this enterprise game with their technology as a business provider, similar to what AWS did at Amazon? And I think there's a hidden angle that they could do this at some point. There could be a really viable business here. And there's, it's kind of like what Waymo did at Google, right? No one cared about Waymo forever, and now they care because they see these cars in San Francisco and they realize it's way better than riding in a car with a person in it. I think you're going to see the same thing in the commercial business. At Meta, we think Oracle is going to surprise in the upside. So those are the names that we like. And again, I'm not saying fade Google, but I think again we're seeing signals that everyone is pretty healthy right now, and I think some of these concerns get over exaggerated.
Brett, my friend, we will leave it there. Thank you, sir.
Good to see you.
Coming up, we check in on some of today's top trending tickers. Stay tuned. Now time for some of today's trending tickers, starting with NVIDIA, the stock tumbling amid a report from The Information that says Google and Meta are in talks for a multi-billion-dollar AI chip deal. Google also pitching its other cloud customers to sell them TPUs in a move that is said could grab as much as 10% of NVIDIA's annual revenue. Bernstein analyst Stacy Rasgon, though, argues that greater competition from Google's AI chips will not threaten NVIDIA's business. This comes as Alphabet, parent company of Google, approaches a $4 trillion valuation. Turning to the crypto space, Coinbase gets hit with a downgrade over at Argus Research, firm lowering its rating on that stock from buy to hold, citing its shares trading at a higher range compared to peers. This comes as Bitcoin has struggled to rebound and heads towards its worst month since June 2022. Bitcoin trading roughly 30% off its October all-time highs of more than 126,000. And lastly, Rothschild lowering its rating on Estee Lauder from neutral to sell. The firm also slashing its price target on that stock from 83 to 70. Rothschild knowing that more investment is needed to close the gap with peers, and Rothschild adding that further investment could dilute the operating leverage into the sales recovery and in turn delay the operating margin upgrades needed to justify the multiple. Well, Wall Street just got more color on the retail landscape as several retailers, including Abercrombie & Fitch and Kohl's, reported their quarterly earnings. Here with the details, we've got Yahoo Finance's Brooke DePalma. Brooke.
Josh, what we heard was from a slew of different retailers, all telling us different things about what exactly is driving their business. Let's start with Abercrombie & Fitch, because that one got a lot of attention. What we saw there was that Hollister brand, one that really caters to the younger consumer, do extremely well yet again this quarter. That brand alone saw same-store sales growth of about 15%. Now, this is the 10th consecutive quarter that Hollister did extremely well and was able to really offset what we're seeing over at the key Abercrombie brand. Now the company aims to invest more within Hollister. They're going to open something like 25 stores and also refresh about 35. But this is really offsetting a third consecutive quarter of same-store sales decline for Abercrombie & Fitch. We know that business had older inventory that the company needed to mark down. That led to another negative quarter for the brand. But despite all that, given that Hollister's doing so well, the company did raise their full year outlook when it comes to sales. They expected to rise between 6 to 7%, and they said back to school was very strong. And then we have other retailers like Kohl's and Burlington. Keep in mind, Burlington is an off-price retailer, but Kohl's has a bit of a turnaround story going on. And what we're seeing there is almost a meme stock-like rally today. The stock last time I checked was up more than 40%. And what we saw at Kohl's was that not only did Kohl's and Burlington both raise their full year outlook, but Kohl's was able to beat on both the top and bottom line. And same store sales growth, well, it declined yet again, but not as bad as Wall Street had expected. And CEO Michael Bender is now going to be the permanent CEO there. Wall Street seems to like the progress that the company is making. And on the flip side, a company that's not seeing a meme stock rally like today is Burlington. That stock moving lower as we make our way toward the close. And keep in mind, that is an off-price retailer. We saw same-store sales growth for Burlington increase about 1%. That was less than what the street had expected. And if you size up Burlington to what we talked about last week with TJX, that's behind Marshalls, HomeGoods, TJ Maxx. That posted a 5% same-store sales growth increase. And so Wall Street not really liking Burlington today.
And before I let you go there, Brooke, what about tech? Because we did get Best Buy today. What's the story there?
Yeah, Best Buy, finally, everything we've been talking about that's finally coming to fruition. That AI replacement cycle, new innovation is finally causing or leading to better same-store sales growth for Best Buy. Same-store sales growth came in about 3%. That was the highest increase of same-store sales growth that Best Buy has seen in about 3 years. And what really led to that increase in same-store sales growth is strength in computing, mobile phones, also gaming. So think about that Nintendo Switch 2 that came out this quarter. We also know that more AI-enabled laptops, also those new iPhones, that all led to strength for Best Buy. And what CEO Corey Berry had told me on a call with other reporters is that the consumer right now is not monolith. She said that generally what they're seeing is a pretty resilient consumer, despite the fact that right now the consumer is under pressure. She also called out that their low-income consumer and also younger consumer is going to Best Buy as well. And certainly innovation, AI, and also she said the right price point is what's driving them in store.
All right, thank you, Brooke. Well, Americans are expected to spend 3.6% more on their holiday shopping in 2025 compared to a year ago. That's according to MasterCard's Spending Pulse report. Michelle Meyer, MasterCard Economics Institute chief economist, joined Market Catalyst to discuss the report and the health of the consumer.
Yeah, so I think, look, I mean, prices have increased a lot over the last several years. It's been this reset of price levels, whether you're talking about the price of goods, the price of services, or even wages, asset prices, everything just kind of level set up from the pandemic. But for the average person, as they're walking into a store or they're thinking about paying their rent or their payment for their car or their insurance, they're thinking about relative to what it was a few years back, and it does feel a lot more expensive. It feels like they have to work harder in order to get some of those items. But it doesn't mean that they can't afford it entirely, or at least not in aggregate, because you're still very much seeing that spending, right? So the fact that wage growth is still running above underlying price inflation, the fact that asset prices have appreciated as much as they have, leads to an environment where we're still seeing that growth, even though it feels like things are so much less affordable.
So of that 3.6% increase that you guys are expecting, is there a way of teasing out how much of it is inflation versus how much of it is people buying more stuff?
Yep. So we have a basket of holiday goods that we track to understand the rate of inflation and get a sense of how much real spending there is or goods. And obviously the inflation reports are a bit delayed at the moment, so we don't have updated data, but we're running at just above 2% or so for year-over-year inflation for this broader holiday basket. So there's still very much real spending and transaction expansion that's happening, which is encouraging. But we'll see as we get into the heart of the holiday season. It will really depend on how deep the promotions are this year relative to last year, and that will influence pricing. And when you think about the holiday season last year, it was a really heavy promotional season. We had deflation in a lot of these goods categories heading into this season, and consumers knew that. So they waited to purchase, they waited for these big promotional periods, they waited till the very end of this season because they knew they had that upper hand in terms of pricing. And this season is a bit different. We're heading in with accelerating inflation. It's not outrageous, but prices are now heading higher, in part because of tariffs and supply chain issues. And consumers are also much, much more conscious of making sure they get the product they need at the price they want. And I think that is encouraging a little bit of an earlier jump into this holiday season on the first look at promotions.
And I guess also retailers are pretty cognizant of that. And if they can offer a deal on something, they are offering a deal on something.
Well, yeah, I mean, there's always the question of market share. So they're all competing in terms of making sure they secure that consumer and that consumer remains loyal to them. So pricing is a big part of it, but it's not the only part. And we see that very clearly in our data as well, that consumers are also prioritizing what matters to them. One trend that we've seen very clearly is influencer-driven spending on apparel. So when there's, a vibe in the market and people really want that product, they become a lot less price sensitive. We are seeing in terms of spending on wellness activities as well, particularly a lot of the gadgets that people are purchasing to support their health and invest in their health. So yes, pricing matters, the search for value matters, but there's more than that that's driving consumers at the moment.
Interesting. And we also have to talk about the different income cohorts, right? Because that's gotten so much attention. So in your data, what are you seeing in terms of spending trends and how they might differ or not differ between the different cohorts?
Well, I think that goes to the macro drivers that are driving that. So when you consider the upper income household, labor income matters a lot, the state of the labor market, but also what matters is the health of the financial markets, what they're seeing in terms of their balance sheet. And if you look at the Federal Reserve flow of funds data, it is extremely clear that there's been a very positive wealth effect over the last few years with this pretty impressive appreciation in asset prices. So that provides a really nice buffer and support for the upper income cohort that is not felt the same way for the lower income cohort, which is much more sensitive to the state of the labor market. And while labor market conditions are still supportive on balance, we certainly have settled into a labor market where there's a lower churn, right? We're in a low hiring labor market, also a low firing one, which is good, but there's just not as much turnover in the workforce, which could be a factor influencing how consumers are intending to spend going forward.
Michelle, I'm also curious about the sort of experiences versus stuff thing, that theme that we've been talking about for a few years now, and how that's playing out this year. Will people still sort of balance that out or even prioritize experiences, spending on future trips, for example, to give as a gift over the holidays and what have you?
Yeah, so it's been fascinating to watch this balance between goods and experiences, as you mentioned. I mean, when you think about coming out of the pandemic, it was all about goods initially when the pandemic was still in play and you couldn't travel. And then as soon as the economy was reopening, it was this incredible rush to get back out there and to travel. And then last year, things kind of settled a little bit and we reached what felt like a more of an equilibrium. And now we're getting impacted by relative price differentials. For some of these larger durable goods, they're more sensitive to trade. They're more sensitive to imports and therefore to tariffs. So the extent to which there's more value being felt again now in experiences that don't have that tariff impact, I think it could encourage consumers to lean more into that purchase, especially if that's something that they value. When we look at our own spending pulse data, we saw a really impressive acceleration in spending on airlines and on lodging and on restaurants throughout the summer into early fall after a little bit of a more rocky start to the year.
Coming up, we take a closer look at the so-called picks and shovels of the AI infrastructure build-out. That's next on Market Domination. Tesla struggles in Europe are deepening. New data showing sales plunging nearly 50% in October, even as overall EV registrations across the region jump. For more, we're bringing out Yahoo Finance senior autos reporter Pras Subramanian. Pras, what's the story?
Yeah, I mean, look, those European problems are only getting worse. Like you mentioned, the ACEA, which tracks registrations, which is our proxy for sales there, and in the broader European area, found that Tesla sales or registrations fell to 7,000 units in October. That's like you said, a near 50% drop from a year ago. Meanwhile, total EV registrations jumped 33%, and overall sales, auto sales or registrations jumped 5%. And meanwhile, Chinese rivals like BYD and SAIC rose again too. So you have a little mixture. So what's going on? More of the same, right? We talked about this before. Musk's unpopularity still sort of remains there. There's better and cheaper competition that are eating into Tesla's sort of gains there. But one little potential silver lining here is that FSD's, Tesla's self-driving software, potentially could get approved scheduled to get approved in Netherlands in February, which could be a big sort of move for them as it kind of will allow them to compete against those other rivals. With what people are saying, the latest version of FSD is supposed to be really good. So we'll see if that comes through in Europe, and that might help boost those sales starting early next year.
All right, switching gears while we have you. That's Tesla. What about Toyota, which you also wrote about in this kind of a MAGA moment? What happened?
Yeah, so the question is, so a lot of people thought that, Toyota blinked, right, with Trump. Said they're going to invest $10 billion over the next few years to improve their U.S. production, right? That's, this comes after Trump's big tariffs, and Trump said himself, go buy a Toyota because that's good, that they're doing what I want to happen. But, we saw Chairman Akio Toyoda also then in the last week or two do this whole NASCAR American-themed racing event in Japan, where he came out and wore a full kind of MAGA outfit, MAGA hat, JD Vance, Trump shirt, all this stuff, big thumbs up, driving an F-150.
Yeah.
And it's sort of like kind of speaking to what, it's Trump's language, right? Like it's an audience of one, and he wants to stay in Trump's good graces. The interesting part is that they gave Trump a win, but Sam Fiorani, a manufacturing expert, told me that, you know what? Toyota was going to spend that money anyway in some regard over the next 5 years. Maybe not $10 billion, but they already announced $1 billion last week on the sprinkling in different plants. Maybe they'll spend half of that, but they never actually promised $10 billion. They pledged $10 billion. They could maybe spend $5 billion, but over the next few years, they have several operations here. They need to upgrade those. They are going to expand some production and add the Corolla hybrid to the U.S. So a couple cars coming here, but guess what? Both sides get a win, right? Trump gets a win. Toyota keeps investing in the U.S. Maybe they invest a little bit more. And what happens is that they basically maintain the status quo. Trump can, keeps tariffs as they are, and the next year is a big USMCA renegotiation potentially, or just the formal revisiting of that deal. So there might be some changes there.
All right, Pras, thank you, buddy. Appreciate it. Well, the next phase of the AI boom isn't about the models. It's about the massive physical build needed to power them. That's what a new report from Stifel highlights, laying out how the biggest bottleneck to AI's growth is now power. And joining me now is one of the authors of that report. That would be Tom Roderick, co-director of U.S. Equity Research and Sales at Stifel. Tom, it's good to see you. So let's dig right into this report, Tom. So you say AI's biggest bottleneck right now, it's not chips, it's power. Walk us through that, Tom. Explain that for us, that dynamic.
Well, I don't think we're exactly treading on new ground when we talk about AI and saying we think it's going to be the single biggest innovation of the next 20 to 30 years. So we're not alone in that. IDC is saying it's going to be 20 trillion to the global economy by 2030. But if you listen to all of the biggest buyers of this technology and all of the biggest hyperscalers, they're saying one thing is slowing us down. It's power, it's power, it's power. And so when we talk about this sort of frontier tech landscape, what's amazing is that, it's no longer the virtual picks and shovels, it's the real picks and shovels that can really be the next phase of growth. So the concept of this report for Frontier Tech was really leaning in on the industrial side of the equation. What's behind the grid for power generation? What are the renewables doing? What are engineering and construction companies doing? What's the next stage of nuclear? And how do we think about battery storage and backup? And we think there's a fantastic opportunity in the industrials companies that frankly have pretty reasonable valuations when you consider what's happened with the tech stack and all the valuations on that side.
So if the theme there, if one theme, Tom, is power, what are some investment implications there? You and the smart folks at Stifel, what are some picks to play that theme?
Well, I think the aha moment for us, and this has come to people in various waves over the last, call it 6 to 9 months, but we had an aha moment when we launched coverage, did a lot of work with a company called Fermi. You had it listed as one of the companies that we're interested in your demographic there earlier. And, when Fermi got to talking about their ambitious plans to build an 11 gigawatt data center in Amarillo, Texas, that's 5 times bigger than the Hoover Dam. And it's a fairly audacious plan. And yet the AI hyperscalers are lining up at the door to get as much power as they can to power their plans up. So when we kind of think about how to play the various sectors, you've got, behind the grid power generation. That's Fermi. That's companies that Stephen Gengaro covers like Solaris and Liberty. You talk about midstream E&P in the energy world. We kind of call this the hybrid between Landman and Friday Night Lights. You want to own natural gas, you want to own West Texas, and that's companies like Williams Companies. And then lastly, let's not forget what's going on the engineering and construction side. Brian Brophy's universe is white hot right now because these are actually picks and shovels. that are pushing dirt around and building data centers. So companies that have major data center exposure, just remember, data centers consume 4% of the US power consumption grid today. That'll be 20% by the year 2040, and it probably triples in the next 3 years. So for Brian Brophy's world, we look at companies like Comfort Systems and MasTec as great opportunities.
You know, you have seen these comparisons being made, Tom, between the kind of this mega AI trade and trend and the dot-com bubble, including some very well-known smart investors have made that comparison. I mean, guys with impressive track records. I'm just curious, as you and the team there at Stifel, as you were reporting, research, and writing this out, Tom, how do you think about that comparison?
Yeah, I love the question, Josh. In part, I'm going to show my age here. But I was there in San Francisco for the dot-com boom and bust. I remember when we valued companies in eyeballs. I remember when the Pets.com sock puppet was worth more than the stock. And, the internet.com bubble was built, castles in the sky and a dream, but the demand wasn't there yet. You were building to a demand that didn't exist. You look today, NVIDIA trades at 25 times earnings today. That stock has gone up 18 times over the last 4 years. And that 25 times earnings is exactly what it traded at back 3 years ago. So I think what you're finding is there's real demand today. And again, I come back to this theme. If you listen to NVIDIA, Microsoft, Meta, Amazon, they all say the same thing. The one thing holding us back is not demand, it's power. We have to build out the infrastructure. And we think that makes for a modern day space race.
Last question, Tom. I'm curious to get the geostrategic take on this as well, because in Washington, clearly our lawmakers, our policymakers, they now think of AI as a national security issue. As you think about kind of comparing and contrasting the U.S. and China, who's in the lead there in AI software and AI hardware?
So I love that you just broke it down into software, hardware, and I'll throw the physical resources at the mix also. I don't think there's really going to be any question mark about who has sort of the superiority in the tech race. We've got companies that I just mentioned, NVIDIA, Microsoft, you name it. But on a geopolitical landscape, when you look at physical brute resources, China, even Russia, there's a lot they can do. Our goal here in the US is to put 40 gigawatts of new power online by year. China just last year alone put 80 gigawatts of new power online in 2024, and 80% of that was done with renewables. And so there's an impetus, and this administration recognizes it. You've got to get permits out. You've got to get data centers starting to be built. Nuclear is a hot topic, so you've got to start lighting up new nuclear facilities and nuclear SMRs. So I think it's, we talk about it as the space race, but I think it's the real deal. There's a political and geopolitical impetus to make sure we move as fast as we can. You've got 3 more years of the current administration, so, shovels in the ground. Let's go.
Tom, big, important report. Thanks for breaking it down for us.
Thanks for having me. Appreciate it.
Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.